Ready to kick off this session. So firstly, welcome. I know that we're competing with other sessions, so it's gratifying to see a pretty full room here. We're broadly going to talk about long-term investing. I think I've been very fortunate to be given the role of moderating this panel. It's a panel that I think Milken should be applauded for a very diverse group of people. 4 separate countries represented, 4 very different types of institutions, and I think all with something to say around long-term investing, and then we'll later on talk a little bit about ESG. So I'm going to introduce my panel briefly and then ask them individually to talk a little bit about their organisation, so you can get a sense of the context for their comments and their thoughts. So. At the end, Tull from the Employment Retirement System of Texas. To my left, Michael Rolland, who's just arrived in Asia to set up the Asian office of OMERS. I believe he had a very successful opening night last night, so maybe some of you were there. To my right, Tengku Azmil, or Azmil to his friends, as I now know. Is from Khazanah in Malaysia, and finally Sophia Cheng is from Cathay Financial Holdings. So I welcome the panel, I welcome you. I'd like to suggest that this is going to be an interactive session. We'll pause for questions at some point, and I'd really encourage you to, this panel is up for anything, they told me, so I really encourage you to quiz them. So maybe we could start with you, Tom.
Okay, first of all, it's a pleasure to be here, and I thank you folks for your time. I am with the Employees Retirement System of Texas. We oversee the pensions for the state workers for the state. We have probably about 300,000 active workers and about 100,000 folks that are retired. We have in excess of some $30 billion, including defined benefit and defined contribution money, and we manage about 60% internally. Bottom line, we are very active. We're invested in virtually all the asset classes you can think of, and all we want is a good competitive rate of return at a reasonable cost.
So my name is Michael Rolland, and I've been with OMERS for a long time, but OMERS is the Ontario Municipal Employees Retirement System. So in Canada, we have provinces. Ontario is one of the provinces, and the municipal employees are the policemen, the firemen, and the people who work in the province. It's 500,000 people in the province of Ontario that we represent. We are currently a $100 billion pension plan with a $200 billion future value pension liability. So we're driven by the liability and the long-term basis. And when you look at our pension, we have people as young as 14 and as old as 106. So we have lifespans that go 100 years. So this panel discussion is very important for us. And I've been with OMERS for 20 years, so I got a bit of history in where we've taken it from where we started. So,
thank you.
Hi, my name is Tengku Azmil. I'm really happy to be here. I'm with Khazanah Nasional, which is the Malaysian sovereign fund. Our mandate is basically twofold: to generate returns for the Malaysian government and to also undertake investments that have a strategic impact going back to Malaysia. We've been around for nearly 25 years now. Probably compared to a lot of other funds out there, we've probably got a slightly higher risk appetite. Our primary investing mode is sort of PE type investments, and that's really been how we've been doing our investments probably for the last 14, 15 years or so.
Sophia.
Hi, good afternoon. Nice to be here. I work for Cathay Financial Holdings. Cathay is the largest financial holding company in Taiwan with total asset about $300 billion US. And of that, about 60% is in life insurance fund, with 40% in banking. We also operate the largest asset manager in Taiwan. And after year 2000, interest rate keep falling. It never really recovered back to the level where 50 years ago, we guaranteed someone 6% for their whole life. So we spent over a decade trying to fix the negative spread problem. And in year 2000, we had only 4% invested overseas. Today, we already invest 65% overseas. Roughly 15% through mandates, the rest done by a big team, internally more than 300 investment research talent. So we always need to balance the return and risk, which is quite a hard task. And so I'm here to learn and besides to share. And also on ESG, we care so much because in Taiwan, half of the population is our customer. So whatever we do, we will think about the impact to the country, to people, industry, and community. And so we have several charities and run a hospital for 40 years. We focus on health management rather than promoting hospital. And we are regarded as pretty good in our industry in terms of ESG performance. We also put tremendous effort on responsible investment, which I can talk a little bit later. Thank you.
Thank you. Well, maybe kicking off and trying to focus in on the issues of long-term investment, Tom. I quote, your fund's mission is to offer competitive benefits to enhance the lives of its members and to support our members' retirement income security. Not particularly unusual goals for a pension fund, but how do you think about long-term investing given the structure and the cohort that you support?
Just to set the stage and put things in perspective, the average worker at ERS spends anywhere from 25 to 30 years at the agency. Then they'll retire for another 20 plus years. So we're getting money from the state, we're getting money from the employees, and plus we have the investment rate of return. And in reality, as those who are involved in public funds, the state has a tendency to be a little slower in paying than the other two pieces. But the bottom line is that we have to be very long-term investors. But we also have a liquidity need. The fact that we're unlike our peers up north, not mentioning any names, but the fact is that we get 100 million in and we pay out 200 million per month. So the differential has to be paid in some way, shape, or form. Accordingly, about 2/3 of the benefit payments that are paid out come from investment earnings. And we've been fortunate in generating returns on the order of about 8% over the last 30 years. So that's a good thing. As far as the philosophy and how that dictates how we do what we do, 1, long-term investors. 2, we need to be diversified. 3, we need to have enough flexibility to meet the liquidity needs that may come about. And 4, which is a good part of dictating how we do what we do, we tend to be very tactical. We don't just construct a portfolio and live with that portfolio. We're believers in looking outside the box in terms of generating rates of return. We like to be unconventional. We are increasing our exposure to the alternative space. We're looking at ways to manage more money internally. And right now we manage about 60% of our assets internally. So bottom line, and by the way, we can do that for about 10 basis points versus 40 basis points. So this is a trend that I think you're going to see a lot of other public funds do as they go forward. Competitive costs, commensurate and competitive rates of return, and looking outside the box and ways to generate rates of return, be diversified, and have an ability to meet the liquidity needs of the portfolio.
Thank you. Maybe compare and contrast, Sophia, as opposed to a DB fund, you've got a lot of banking and insurance assets in the portfolio. How do you think of things differently? What's driving your philosophy?
Banking is more straightforward because overall, due to the low rate, the deposit and time deposit and savings, the demand deposit gap is quite narrow. So in general, most of the banks, they are running a very short deposit duration, where the lending, given the low rate also, if they are corporate client, they tend to demand floating rate. So it's more straightforward. For insurance company, it will be more different. Cathay Life is over 55 years old, but unlike Tom just mentioned on the liquidity need, we're still running massive operating cash inflow. So the headache mainly come from where to allocate asset with the yield that I need to pay for future claim. So on the net cash flow basis, we are okay. And then but we are also a listed company, so we have a negative spread, which when the rate fall, we will suffer. We still run a little bit negative spread because we refuse to buy good yield but riskier asset, and we also don't want to sell very short-term insurance policy, which when rate go out, they start to surrender. We can easily close the gap today, but we choose not to. And therefore, we run a very long-term investment mindset, but at the meantime, we also have a little bit capital gain trading. As a listed company, you want to have positive accounting earnings. And this relates to long-term investment. I think long-term investment culture is basic, but I always puzzled, what does long-term investment mean? Does that mean as a duration? Or does that mean we are investing in the investment instrument, the company has long-term prospects? We are sitting in a world where lack of risk pricing discipline. So the bond yield is too low, the bank book yield is too low, the credit spread is too low. So when we think about insurance book, you got liquidity risk, credit risk, duration risk, forex risk, and capital gain risk. We have chosen to take these three, that I run a shorter asset duration because we think rate eventually should go up, and we think capital gain risk may be not as bad as callable bond, high yield bond, which everybody jump into the area. But to do that, every asset category to us, asset allocation means risk allocation. So every asset category, we will allocate dedicated team. For example, fixed income team, we have 3-4 teams, and we invest globally. So today we have 65% in overseas, and the total book about 65% in fixed income, 15% in equity, half domestic, half overseas, and then about 15% in mortgage, secure loan, and insurance policy, the loan against the insurance policy value, and roughly 8% in real estate. We have more limited alternative investment, which however is quite sizable given our total asset size. The capital charge on PE fund, hedge fund is higher. The government is opening that regulation, so we have some more room to do that. So on the whole group, how do I manage the asset allocation? One, the life alone, we have more than 300 people in investment research. Cathay Asset Management also have another big team. And given the size of overseas footprint we have, we also have a dedicated hedging team, more than 30 people. And I also lead 15 economists directly under myself, and they hate me. So because sales side will give you research about 3 to 12 months view. And but given the size, you can't turn an aircraft in 2 seconds. So I need to have an internal think tank looking at the long-term slope and turning point. And on top of that, we appreciate other good fund managers. They run mandate book for us, so we also learn from their insights. So keep fingers crossed. So far, so good. And we can sleep well, but we'll continue to work hard.
Thank you. I feel I should give you a chance to respond to the suggestion that you have nice, easy liquidity situation to deal with, and you're not dealing with outflows and so on. What are your thoughts on that?
Well, historically, we were at a stage where the contributions coming in were more than enough to pay pensions, but that's changed for our pension plan. So we're at a stage of becoming more mature. So of the 500,000, it's a 2-to-1 ratio of working to non-working. So over time, we are in the stage of becoming much more mature. So we do have the cash outflow, so investment income is very important to us. But as I said to you before, given the age and the lifespan of our members, it's really important to us to deliver long-term stable returns. And because we're a defined benefit pension plan with a discount rate, we have an absolute return target. And we have to drive towards that target. And so as a result, we're looking long-term, and it's not month to month or year to year. It's in a 20-year period, so we can weather the storm on the short term, but it's the long term that we're looking for. And we're probably not looking to reach too far high in the risk cycle. We'd rather be a little down and a little bit more stable, take some volatility out. And that's why when you see our portfolio, what we've done to try and move ourselves along on a way to pay the pensions. But we've got the same problem of there's not enough cash coming in to pay everything, so we have to run our investment book to make sure we pay the bills now.
Right, right. Azmil, you talked about having perhaps a longer term investment horizon, and one of the things we talked about is that you're not facing the issues of inflows and outflows in a traditional sense, but you have to pay your dividends, you have to satisfy some of the financing costs of some degree of leverage in the fund. How does that impact the way that you manage the portfolio? And I think particularly interested in the idea that every time you make an investment, you need to disinvest in something. So there's kind of two decisions to be made at that particular point in time.
It does. So we're quite often people refer to us as a sovereign wealth fund, which we don't normally like, because the main difference is if you look at other sovereign wealth funds, typically they're funded by oil money, and they get very constant. Every year they get an inflow of funds to manage. That's not actually been the case for us. On a net basis, probably for the last 14, 15 years, we've actually had no cash injection from the government. Actually, we had one, but then they asked for the money back. And we've been paying annual dividends, without fail every year. So the one difference between us and what you traditionally call a sovereign wealth fund is we have no new money coming in. So there are really three sources of investments, which is basically we reinvest income, we reinvest money that we've disposed, or we borrow money. So we do have some leverage, but we do need to make sure we control our leverage to make sure we don't increase our financial risk too high. So therefore, you end up really with the second one, which is we can pretty much only invest money from investments that we've already divested. I think one of the things that has made us very careful in terms of looking at investments, because when you don't have money coming in, a mistake or an investment that loses money actually has quite a big impact, because the government does expect a certain amount of dividends from us, and I think we've never failed to provide dividends that the government requires. But we also need to make sure we manage the cash flow in terms of what goes in and what goes out. So if we look at the normal horizon for us, our typical investment period is about 8 to 10 years. I think we're quite lucky in the sense that we manage only our own funds, right? They're the historical portfolio that was given to us by the government initially. So we're not like a normal PE fund that's got a fund life. As you get to the end of the life, then you have to start selling down, whether or not that's the right time to sell. We actually will sell only when it's the right time to sell. And secondly, I suppose because we don't have the pressure of quarterly reporting and so on, we do voluntarily report our numbers every year. We're not under the same pressure as a listed company would be in terms of how your fund is performing in the short term. And I think we've also been quite lucky. We have been around for a quarter of a century. We do have enough of a diversified portfolio that usually, in investing, you always have some stuff that makes money and some stuff that loses money. That on generally, most years we balance stuff that makes money and lose money. And typically, we make money almost every year. I think the run rate for the last 14, 15 years, we're looking at about just under 10% IRR, which it's I think pretty decent for the sort of investments and the constraints that we have.
Thank you. Look, in terms of going a little deeper, I'd be interested in perhaps talking about some of the things that are themes, issues for all investors, not just from a long-term perspective, such things as factors, talent, volatility, alternative investment. I'm going to ask each one of you a question and try and lead that conversation. So talking about factors, Tom, maybe you could start us off with a view. Does it play a role in the way that you're thinking about things? Is it really what some people would like to say it is?
We look at factors. We are probably neglect and not doing risk parity and a lot of the other styles that are in vogue, or looking for smart beta or dumb beta, whatever you want to call it. What we do, however, is we are very aware of the factors that contribute to how we're investing and where we want to be. So we look at momentum, we look at value, we look at growth. We take these into consideration as to where we are in the cycle, and that helps us build better portfolios. Such a good part of the public side of the markets we're invested in are areas that we're doing internally anyway. So that gives us a roadmap to work with. So yes, we use factors as a tool, just like a lot of other items are used in managing the overall portfolio.
Any thoughts?
We do, but the way we've looked at all of our investing is just saying we have to go back to our absolute return. And we have to invest through the cycles, and we just have to look for the best quality asset. And we are a little bit different. We may talk about it later just in our mix. So we've gone away from as much. So we're actually trying to reduce our exposures in the public markets and get away to more privates as a way to take the volatility out and directly manage our assets ourselves. So one of the things that Tom talked about earlier is, so we probably manage ourselves internally 90 to 95% of our assets ourselves with our team. So we're direct investors in all categories of investments, right down to the venture space, in which our gentleman who runs that is in the room today. So we've got that right across the place. So we have a place in Silicon Valley that looks at that directly. So we're not relying on third parties to do that. So we've been very focused on that as we try and drive along against this absolute return target we have.
Azmil, any thought on factor investing?
So we don't use factors at all, right? I mean, because our investing style is very much PE type or very occasionally VC type. So we don't think about asset allocation and risk in quite the same way. So for us, I mean, the nature of PE investing is it tends to be quite often situational. So we actually use very old-fashioned methods, like country, currency, sectoral allocations, very rough allocations as opposed to anything more sophisticated than that.
Right. Sophia?
When we look at the insurance asset, they tend to start with a team. We look at global macro, and then we're thinking of a current 1 to 2 year environment. Should I add more asset into some category? So far, as our current mix, we already think it's quite optimal. And we are looking for if there is market volatility, equity. Obviously, it's easy for me to unload versus the callable bonds or high yield stuff. And then we will delegate into every team. So pretty much the structure.
Right. And you mentioned volatility. How do you manage for complex volatile markets we're dealing with today?
I think these days people have fear, but people are also greedy. And then over time we'll get used to higher and higher valuation, and then certain volatility is low. So it's always important that when we chase the market momentum, still think a little bit of risk pricing into the mind. So for example, if we were thinking of a very thin credit spread, we may just be happy to let go of some of the EMs, which will be most volatile against US dollar strength. Or when we think about 2017 being the global recovery, once in a decade opportunity, there are a few countries that we think, yes, they may be sizable, but their government is not putting effort to improve their overall quality, then I'm happy to let go of the yield. And being an insurance company, it's besides investment, there's always one side, which is another beauty, is I can also work on liability side. So I can reduce not just on the asset portfolio, but the insurance policy risk. We have been selling much lower guarantee rate versus a portfolio book. The new guarantee rate we offer is only 2-something%. So we have been able to average down the insurance cost. So the overall blended, if you look at the portfolio in 2007, at the market peak time, the insurance guarantee more than 4%, dominate 80% of the book. Today is only low 40s%. And then we also were the first insurance company sell unit-linked policies, so I can outsource some of the market risk back to a customer. Our market share in that is 40%. And on top of that, I can sell foreign currency policies, because naturally in Taiwan, people love to hold US dollar. So it's just rather than US dollar deposit, now they go to US dollar insurance policy, so we can have dedicated team manage their money. This also helped me to reduce my forex risk. So based on that, you can, and lastly will be possibilities floating rate policies, which we don't like that much, because if rate eventually go up, you also have to share out more, which is very low margin. And the 2008 financial crisis gave us a very big internal debate. No more market share, just think about value. So when we think about a new product, the product team, the investment team need to work together and think about the implication toward IFRS 9 and IFRS 17. So today our break-even asset yield is down to 3.3, 3.4%. That's very manageable. Yeah, so just try to remind, don't try to fight EPS with your major peer, and you can spend a lot of time communicating with your investor that they appreciate your risk pricing discipline that works. And then the other one is, so today, foreign currency insurance policy is already 20 to 25% of my overall book. So that's also helped a little bit. And then we also put so much effort on global macro research. If I can constant foresee things in 2 years from now, I can try to communicate internally and do a little bit earlier preparation. So for example, earlier, January this year, we were thinking the market valuation just a little bit too pricey. And we were happy to lock in some of the gain. And we're so lucky that after that, the market just has a big correction. Yeah, so just try to adjust it when more challenge comes. But overall, it's really not easy.
Let's maybe turn to alternative assets. Every major investor is more and more looking to alternatives to establish long sustainable returns. Each one of you has different elements of alternatives in your portfolio: private equity, hedge fund, infrastructure investments. Tell me about the unique challenges associated with those. I think we all, understand there's, it's certainly difficult to get investments away, whether you're partnering, whether you're, a single investor. But any thoughts on how you build the portfolio and are very inclusive of alternatives, and also a suggestion of whether you think that whether you're at the right place today, or whether you think there's a larger part of your portfolio going to be ultimately in alternatives.
For the next hour, no problem.
Okay.
Okay. We're believers in alternatives, without a doubt. We just went to an asset allocation, and we're going from 26% to 37% over the next several years. The rationale for doing that is severalfold. One, of course, the competitive rates of return that we can get versus the public markets, but also is a belief as well that we're continuing to see the public markets dry up in terms of liquidity, whether it's ETFs supplanting the public shares that trade, to the fact that was made earlier today, there's more private equity companies than there are public companies. Strangely enough, the part of the global universe that will probably show more liquidity are the emerging markets. Even though all emerging markets aren't created equal, it will most likely be emerging markets, which are growing at at least 2 times the rate of the U.S. So, all taken in, we are believers that you can pick up great rates of return on a global basis, whether it's private equity, private real estate, infrastructure, hedge funds, and these are all areas that are providing tremendous rates of return at different stages of the cycle. I say that last point because you can't just put your money into an alternative asset class and let it harvest it and walk away. These asset classes anymore have to be managed. Now, whereas in the past you'd buy a partnership, you'd let it run for the 5 or 7 years, now we're finding ourselves going into the secondary market and shortening or expanding or reducing our J curve depending on where we are in the cycle. Right now we're looking at more secondaries because we feel that the private equity space is overdone. And we're also going into the smaller firms that are willing to, we'll call it, be more covenant strong rather than covenant light, not have as much deal inflation, and also be a lot more accommodating in terms of being able to negotiate management fees and profit sharing. We are also spending a lot of time in the infrastructure space, and we have a lot of competition and a lot of other folks that we're working with as partners in infrastructure. Most of the money is being spent outside the U.S. right now. We're finding better rates of return. In fact, emerging markets, we've been doing deals in India and in Latin America, as well as in some of the smaller emerging markets, the Philippines, financing call centers, as a lot of the call centers are moving from Bangalore to the Philippines. But in all, we're looking at alternatives as a space where we can get better returns than what we can get in the U.S. market and in a lot of the international markets. Add to that, we're getting more actively involved in opportunistic credit, which complements some of the alternative space as well. So it's overall more in alternatives, broader portfolio in terms of how we do it. We'll look at seeding, we'll look at direct deals, we'll look at co-invests. There's no one definition that fits all. And it's a trend I think you're going to continue to see as we go forward.
Well, from an OMERS perspective, we are long in the alternative space. My career started with OMERS in 1999, starting an infrastructure business that is now a reasonable sized platform where we actually manage money for OMERS and for third parties. But if you look at OMERS today, 45% of our portfolio is in alternatives, whether real estate, private equity, infrastructure, and others. But those are a big part of it. The other side is we've stepped away from public debt. We've gone to private debt. And we're not in the public debt market. We're trying to move away from that. And we're also in a space where we're trying to get our equity exposure in the public markets down. So overall, we have a discussion that today we're at 45%. And our goal is over the next 5 years to get to 55% on an orderly basis to invest in the alternative space. And we've had great results in that opportunity. Now, one of the ways we've done that is we have dedicated teams. We have teams in London and New York and Sydney, Australia, and now Singapore. It makes a big difference. So we actually have the full suite. I mean, our real estate team is world class, and we have over thousands of employees that do from soup to nuts in the business. So we'll build a building from find a site all the way up and develop it. So Oxford Properties, which is our real estate arm, is a showcase of what we do in the alternative. So it's something that we believe in a lot, and it's taken a lot of volatility out of our space. And as you see, we continue to reduce our exposure in both the debt, public debt markets and also in the space of public markets for equities. We're really trying to get the volatility out and just get the best quality returns we can. And for us, it's worked very, very well. But as a result, we've got a very large team dedicated to invest in that space. And people are actually paying us to do that in the real estate space, the infrastructure space, and even in the venture space. That we're third parties that maybe some of the people in your organizations have actually on the other side of the table where we've using our expertise to coalesce capital to make the opportunity to acquire high quality assets in the competition opportunistic for us.
So you talk about that evolution of the portfolio towards away from public markets. I mean, as a bank, we obviously march to a 90-day tune, and so a lot of what we do gets shaped by that. Is it very clearly aligned with a long-term return that you just think it's easier to step away from that natural conflict of investing in organisations that are perhaps looking at a much shorter outcome in the way that they're managing their individual firms? Is that a fair statement?
I think that's fair, and I think the other side are, if Satish Rai was here, our CIO, he would say he's wanting to get away from much of his capital being affected by somebody at a blowhorn setting the price or something happening in the marketplace, and getting away from that, so moving more to privates, where we control it, we manage the asset, we have people in the space doing it. I mean, you think of the businesses, we have control positions or negative control in almost every asset we invest in. So we have dedicated business teams. I used to talk when I ran the private equity and infrastructure business for OMERS that we had 100,000 people that went to work for us every day in the businesses we own. And that was part of the puzzle. OMERS is only 3,000 employees, but that's what went away, and that's how we built it, by having control or large stakes in the businesses. And it's been really important to us. We have these virtual teams, so we have the skills, and we actually, by bringing teams together, we use the resources of one asset to others, and they learn from each other, and that's the best bonding we have, because we have our own built-in teams for asset management, because that's a critical piece of, you buy an asset, it's not just buying it. It used to be, when I started in the infrastructure business in 1999, it was easy to make money at good returns. Now, it's eye-watering prices, so you've got to be able to drive results and outperformance in that asset class and any one of the pieces. When we're in the real estate base, we've got to build it. So we do a lot of development projects around the world on the real estate side, because that's how we can get the returns with low cap rates, by actually building from the ground up, buying the land, developing it, and then managing it for ourselves and third parties.
So a lot of people talk about the challenges of finding opportunities in private equity. Valuations are typically considered to be high. How are you going to find return? Where are the new types of deals going to come from in that space for you?
Well, I mean, it's probably why we're here in Asia, is to start a new platform, because we've spent a lot of time investing in Western Europe and in North America. And you know, as you continue to grow, and if you go back to my opening comments, we're $100 billion today, but the liability is going to be $200 billion. So that means we've got to fill and invest to grow that, match the liability side over time. But it's also by absolute return and looking at the best quality, with not looking to, you know, knock it out of the park. We'd like to hit singles and doubles as compared to, you know, home runs. And if we can do that, that's a really important part. So we want to buy high quality assets. We'll pay the price for them because we can manage them and generate returns, as compared to taking ones that we think we can hit very high multiples in the space. And that's what we've tried to do as we've gone down. But it's tough, but that's why having a dedicated team that's out not just on asset management, but searching and building partnerships. I mean, the reason we put our office here was really to start building relationships, and why we have offices in the different parts around the world, because we can't do it by flying in and flying out. We believe if our CIO or CEO was here, he'd say boots on the ground is a critical piece of our success, and having people that live and breathe in the community. And that's part of my new gig, and trying to do that. So all of you here that are from Asia, whatever you can do to teach me, I'm willing to listen, so thanks.
And Ian, one other thing, that's why we're going to be very close to OMERS, so we can come visit and take advantage of the opportunities. Huh?
Absolutely. That's one team, right?
Mm-hmm. Nice pension case.
What about your thoughts on alts, and how you, particularly the way the markets are evolving and the challenges in finding the right sort of home for your investments?
Yeah, so in a way for us, it's really been quite annoying, right? That now everyone's looking at alternative assets, because we've just, as I said, primarily been PE investors, and we can certainly see that the market's gone a lot more crowded these days. And you know, our assets under management is about $35–40 billion, which is sort of not tiny, but not particularly large either. I remember some years ago I was talking to CPP. I think Mark Weissman was running CPP at the time, and he was interested in finding out from us how we did our investments, because you know his view was that, you know, alternatives are going to be much more important for CPP. We really want to do a lot more PE investing. You know, you guys do that all the time. What can you teach us? And we were quite happy to have the conversation. So at the end of the conversation, I just sort of said to him, yeah, you know, so how much do you have in PE now? He said, oh, it's really tiny. It's about 40 billion Canadian dollars, which is larger than us, right? So I think it is challenging. So from us, it's sort of, I suppose, as people who've been in this space for quite a while, it does mean there is more competition for deals. We've certainly seen valuations increase over time. And I think definitely in Asia, we invest globally, but most of our investments are still within Asia. And I think we've just had to adapt how we look at PE investing. A lot more investing that we do these days, we actually do in partnership with somebody else. So as opposed to doing stuff alone, I think fortunately as Asia matures, we are starting to see larger and larger PE deals. And that creates room for more than one player to come in. And I think my sense is, particularly for a lot of players, and you can agree or disagree with me, as people who perhaps aren't as familiar with Asia start doing Asia, or people who haven't done as much PE investing start doing more, they actually welcome partnerships and working together. And I think for us, that's increasingly a style of investment that we do. In a way, we sort of get somebody else to validate our thesis as well. And I think it's just useful. I think different partners can bring different skill sets and different experiences into a deal. And I think conversely, I think these days there's a lot more exits by PE to another PE. So to the extent that there's actually a lot more people out there, it actually helps us for positions that maybe we've been in for quite a long time, having another option to exit other than simply just a trade sale or IPO, actually being able to sell a stake or a company to another PE investor, it actually just gives us more options. So it does make it more challenging, but I think good challenging overall, but it does, you know, we do need to be on top of our game in order to stay competitive.
I would just agree with you 100%. The partners are very important, and it's not that we own every asset 100%. So we are looking for partners, because I think the validation is very important, but also in every new region we've gone into, we've never been so arrogant to say we know what we're doing on our own, so we want to have local partners. When we went to the UK, even though we both had the Queen on our bill, it was, you know, from a perspective, we wanted to have British partners in our first transactions. Because we wanted people that knew the way to walk around town, because there's always going to be a bump in the road in the piece, and it's important. And on the private equity side, it's certainly one of the things that I think is we're trying to build the relationships. And the example I would use is we've done more than a few $1 billion in acquisitions this year in the private equity space, and all of them have been bilateral. So they haven't been through competitions, and it's building relationships, because they also look that we're happy to hold the business longer. If it's giving us high quality returns, we don't have to sell it. It pays the pension. So we're not in a cycle that says every 4 years we're out. So if you have a management team that wants to join on, and in any of the space, that's something we're able to do. And I use the example in OMERS, we have a real estate asset we've owned since 1971, and we still own it. We've developed and redeveloped, so we'll hold it for long term. So when we go talk to partners and management teams, one of the things that we've had an advantage of is we've had the ability to say, we may not exit it in a quick turn, so that people want some stability as compared to them presenting themselves for sales every 2 to 3 years. It's been an important part of that. And so the 3 of these transactions, and the bilaterals, were not normally the highest price. It's about a relationship, which, as I learn and walk around in Asia, it's such an important part. That's what we've hopefully bring to the table, because we've done that before on our home turf before. But it's an important part. So.
We should have a chat.
We will. I'm happy to. Are you going to
get the commission? Surely.
You're in the commission. You're banking right now.
I'm a happy broker. That's.
You call me too when you are about to have a chat.
That's right. Doing deals up here. That's fantastic. Look, I'm conscious that a bit of crowd participation. We are going to talk a little bit about ESG before we finish, but I'd be delighted to take any questions from anyone in the audience.
I have a question. 3-4 years ago, in boardrooms in Dubai to New York to Tokyo, we're all talking about that the traditional fixed income and equities is not doing it. Hence, now, 3-4 years later, there's no more talk. I mean, it's serious. So I'm trying to understand from the view of the pension or insurance, as they look at this rotation to alternative, which makes your life even more difficult, how is that playing out, and how much is going to flood into this private markets to make it even less appealing, if you can be specific?
Who would like to have a crack at that?
Maybe I can, because we invest the least in PE fund. So it's not because we don't want to, just a regulation in Taiwan, there's some constraint. But I think for life insurance in Taiwan, we mostly still invest in fixed income, because I have a long-term liability to match. But for Cathay alone, we have more than 200 office buildings in Taiwan, so I have very stable rental income. Real estate is about 8%. And then we also, when we think about a PE fund, we also consider co-invest opportunity. I must know what I'm investing. And we may know a PE fund for 2-3 years before we really make the investment, because sometimes you need to know their performance come from the right industry or their right skill set. PE fund, to me, sometimes I feel it's a side product from low rate, because a prolonged interest rate is killing households' wealth, because they don't have enough interest income. They start to affect their spending. And very low rate and low spread for banking, bank will start to shift into the safe spectrum in the risk profile. So as a result, banks losing the function day one why we need a bank. And therefore, you have more corporate there go to PE funds. So today we are celebrating PE fund, big, trillions of dollars, half not allocated, blah, blah, blah. Yeah. So I do share a little bit concern as the overvaluation into PE fund and passive investment. We keep telling people passive is good ESG perform well, which not until they correct, because we are buying the same thing. If the market correct the same thing, we redeem the fund, they sell the same target. So I do think when we invest in PE fund, we'll look into the fund more like a partner, regardless we partner or not. In Taiwan, the PE fund, when we invest, globally, we look into buyout, growth, the renewable energy, healthcare. Where in Taiwan, as we can see closer with the government and the regulation, we are the biggest investor into solar industry. So some of them we done it through funds, some of them we do co-investment. So we have the biggest investment by insurance. We are also the biggest lender to the solar installation, so we can help the farmers on the roof. They can improve their living, and so a little bit of ESG element to it. Yeah. So we'll still grow, but I think having a discipline, knowing who you are investing, not just on the yield, that will be safer. And eventually, when there is a volatility, credit spreads start to go to a reasonable level, I do think the corporate credit, government bond will still be something that people look to lock in a better yield.
Tom?
Just to add a couple bits of info, I'm a believer that there's a season for every investment. And a lot of times boards have a tendency to overreact given the current environment. So, for example, boards wanted everybody to go passive when we were in 2016. And that was the time when you wanted to go active for 2017. So it's a board thing. But with a season for every investment, there are times when fixed income has done very well, and there's times when it has been more challenged. And historically, during that time, it was being challenged because the banks were under duress. They were being forced out of a lot of businesses. Accordingly, the private equity firms could pick up that business and pick off oil companies and financing at very good competitive rates of return. That environment's changed. Now the banks are getting back into that business under the new rules, the demise of the Volcker rule, and Dodd-Frank is now being converted back to what it was before. So it will be a different environment. With all that being said, it pays to have flexibility to entertain different cycles and different instruments during different cycles. And we're in the process of building a high yield or credit team internally rather than have it done externally. So not only can we get the expertise of that team in evaluating deals and in the private side and also on the fixed income side, but also to help complement on the equities. So my point is that it is a phenomena where investing is almost seasonal, depending on when your snapshot in time is. And it's going to vary as to whether or not you go into alternatives or how aggressive you go into alternatives versus stay with the more liquid markets.
I'd like to maybe talk a little bit about ESG. I think there's more and more some really credible research demonstrating long-term outcomes for those corporations that are adhering to ESG principles, but at the same time they're still relatively ill-defined, or there's lots of differing views on how you build that into your portfolio. So perhaps you could maybe share with us some of the ways that you're thinking about ESG.
ESG is so important, yeah, because when rate of return is so challenging, at least you want to avoid things which is material and it's not quantified yet today, but it will create later significant impact to financial performance. And naturally, if there are so many investment targets you can choose, why sponsoring a corporate where you doubt about the ESG? And I think given the global asset management industry already over 70 trillion, as an asset owner, asset manager, there's a natural duty we should care about ESG. And the next question comes on whether ESG will affect your performance. To be honest, when we went through all the ESG analysis to our portfolio, there are so few names. They are superly bad in a controversial issue or in very low ESG rating. If you start with at least don't sponsor the worst company, that's a little bit of effort. So Cathay Group in 2014, we set our responsible investment team, and myself is the leader for the team. I'm very passionate about that. And since then, we are the first Taiwan bank who signed Equator Principle. So if we had the biggest Southeast Asia footprint among my Taiwan peer, it's very good day one I decided what money I don't want to earn. We are Taiwan, because of the Taiwan-China relationships, we are not a UN member. We are not allowed to sign PSI and PRI, but we self-compliance to that. We have been disclosing our progress report on an annual basis. We have dedicated ESG analysts, and we are the only financial group, I think we buy a whole set of ESG database. And it's only when you start to do it, you see the beauty of that, and your employee feel proud. They can do a little bit of effort as a human being, care about what we are doing. If you think about half of population is my customer, on customer behalf, what company do your customer want you to support, to lend to? So to me, it's quite meaningful.
Azmil, I mean, you have to some extent the luxury of making unilateral decisions as to where you want to invest, so you can explicitly exclude certain sectors, types of firms from your portfolio. But how do you think about ESG?
Yeah, so we do think about it, but perhaps in a slightly different way. So we've, in terms of a formal ESG policy, we've actually only had one fairly recently. But for the longest time, we've always been very conscious in terms of avoiding investments, in any of the sin stuff, tobacco, gambling, alcohol. We actually have no investments in mining companies. For the longest time, even though we didn't actually have a formal policy. In terms of where we've been looking at it, because we felt that we were, a sovereign fund for Malaysia, there was a certain reputational risk with being associated with investments that wasn't good. For us, our mantra was always in Malaysia, we were always a good corporate citizen. And where we invest outside of Malaysia, we will always be a good corporate citizen in that country. So, beyond just ESG, wherever we have investments, we also try and do some CSR on top of that as well. So it's all anchored in terms of reputation and, would this be an investment that, even if it makes money for us, would potentially reputationally be damaging for us. So we've tended to shy away from anything that's, overly polluting or doing things that are really not good for society as a whole. More recently, for example, one of the banks we've been associated with actually has taken a much more active ESG policy. So they won't lend money to any company which fails their ESG criteria. And interestingly, they decided not to do that, not because they wanted to be ESG compliant, but because they felt it was bad business. And I think that's how we like ESG to be looked at going forward, where it's not about, we need to be seen to be doing this, but actually it's just business.
You have a different slant on that, or?
I had a couple comments. If we look at the world, we recognize the fact that the Europeans are ahead of the fray in terms of implementing ESG. The Asians are second and the Americans are last. We are seeing more and more encouragement to hardwire ESG into our investment policy statements, and we're doing that. We've got the G covered in terms of delegation of authority and engaging corporate boards around the world, and particularly the Japanese firms, to bring in more independent directors and the like. And we're also continuing to build on that in other countries. As far as the E and the S, there's a lot of conflicts. We get the fundamentals in terms of where can you generate a rate of return or not, what do you give up with social consciousness and so forth, and what can that cost. We look at things on the total portfolio basis accordingly when we invest. But I can say that we'll most likely in the next year or two have a hardwire on ESG policy into our program. More importantly, on the other side of that, we all look at it as the companies we're investing in, but we also want to make sure our organization is consistent with ESG. Gender diversity, getting more women involved in the investment business. I'm a supporter of Wall Street Women and also some other organizations that are broadening the diversity, but also reducing the pay gaps between different folks in the marketplace. We're also getting very actively involved in assisting some of our brother agencies and sister agencies in making the right decisions as we go forward and putting together an ESG policy. And finally, if public funds don't do this, the alternative is most likely we'll have our legislators dictate what their interpretation of ESG is. You know, whether it's investing in Iran or Sudan, no, or what you can do, whether it's tobacco, alcohol, correctional facilities. If we don't do it, they're most likely going to encourage or dictate us as to how it is done. So that's, I think you're going to see more urgency overall because of that.
At some point, I must highlight a few things. We have basically announced public over our ESG integration in bank loan and investment. But I must highlight, please do not make a simple, lazy marketing phrase saying company better ESG means better share price. Typically, when someone gets wealthy, they want to look elegant. So I think usually only large company who can afford also do more ESG initiative. And therefore, I think it's very too quick and dirty phrase saying good ESG means good performance. But I try so hard. Is there any fund which really start with ESG and do good performance? You can refer to generation funds. And I see that it's possible. But given the nature constraint from ESG good companies, the size could be small. So we can do from my own ESG criteria, I can invest in an ESG themed fund. And most importantly, as investor, people in this room are all the smartest person on planet. Every one of us should do engagement. Only when we get vocal to the corporate, not to criticize the bad ones, but if some good company, they are being lowly rated in ESG, simply they don't know how to disclose, they don't do up to the global standard, help them to do better, help the good company to succeed. Not just say good ESG means good share price. I hate the phrase when I hear it.
Food for thought. Like to open it up for any questions. We have 1 minute. It says 4 down there. Yep.
So in long-term investing, you make long-term forecasts, and sometimes that will express itself as a long-duration specific investment. Could you say a bit about that subclass of situations where the long-term forecast is wrong? How do you decide between making a short-term exit or riding it out or doubling down?
I guess from our perspective, we're always looking for the best quality asset, and we will cycle out of assets not based on long-term, short-term, how they're performing. And we only have a finite amount of capital. So we're making that conscious decision that this may be, so you think about buying infrastructure assets, we buy them for a long term. But we have translated out of assets and into new ones because we think they're better quality assets, and we do it through all our asset classes. So we're doing that all along. So if the forecast, we do get things wrong. We're not perfect by any means. So things that we think is the business case is wrong, or the investment we make, or the term, or the projection of what we think the economic cycle will be. So we have to adjust, and we're constantly doing that by being an active investor and controlling our book ourselves. It's helped us be able to move along because our team meets every week, and all across the asset class, they talk once a week about what's going on and what do we need to do. And if we're going to invest in this, we decide we want to invest in a fixed income. So maybe we take some money out of the equity market, or we take some money out of, we were selling infrastructure assets, we may invest it in real estate assets, a better return. So we're doing that all the time. So it's a constant movement. It's not, even though we're long-term investors, we're always comparing and saying, is there something better that we should move out of and into? And it's a constant dialogue all the time. When I ran the private equity infrastructure business, we'd say, why would we buy new? This one's better, or we should sell out because there isn't any juice left in that lemon. Let's move along and take it to the next stage.
Just conscious, we've run out of time. 15 seconds each. You're all long-term investors. What's the 10-year thing? What's the 10-year thing that you're most interested in 15 seconds each?
She's tough. Let me pause for 15 seconds. Very, very, very simply. Beware of the fact that the market will definitely change. I think you're seeing a trend that Michael insinuated beforehand. You're going to see more public funds get more actively involved in third-party business as we go forward. That's a trend that will continue to take place, and accordingly there will be more competition within the marketplace, whereby good minds can pick up good opportunities, and we can all benefit accordingly.
Speed of change and innovation, because anything we hold, and if we're holding long-term assets, making sure we don't and fall in love with something that is now at a spade and it just goes right off the cliff.
Yeah, I think sometimes just avoid stuff that's just too sexy, right? So for me, consumer has been a very strong trend in Asia, and I think for the next decade will continue to be a very strong sector that I think will continue to do well. But I think probably the other thing, particularly in Asia, we're starting to the demographics are starting to shift from the dividend of having a very young population, I think in the next decade or two, to having an aging population. So I think there's going to be quite interesting dynamics around that. That I think everyone knows that, but I think from an investing point of view, I'm not sure people have really been thinking about that.
Totally agree. And besides, I hope central bank at good macro time can maintain a good discipline, try to shrink back their balance sheet, and then we can have a proper rate, and I can lock in asset not to discuss all the questions we have just discussed. On top of that, I think people always worry about things we don't know. I worry the most about things we know. We thought we know, but we underestimate the risk, especially climate change. And I think people should really put on TCFD on the science-based target to really differentiate the pricing, what company I should lend, what company I should invest, what risk premium. It hurts. Thank you.
I would, sorry we ran over a couple of minutes, but I'd very much like you to thank our panel for a great discussion. Thank you.